What's up everyone, it's Scotty with Money Investing. In this video, I wanted to break down inflation expectations from a consumer survey done by the New York Federal Reserve and also talk to you about how right now hedge funds are currently net short, the highest we've ever seen in over a decade. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below, so you can access all the buy and sell alerts, options alerts, trade ideas, all the private videos and member benefits, including the most recent video I posted literally about an hour ago, 39 minutes ago, for trade ideas, and of course giving you some additional lessons and education on some trading concepts and ideas as well. So link's going to be down below if you're interested in joining us, and you can access all these private videos and all the member benefits and all the channels included in our Discord as well. So link's going to be down below. So this right here is going to be the survey expectations. So New York Fed survey finds Americans' inflation expectations for the next few years have jumped. And I'm going to go over the next 3 years, 5 years expectations from what the Americans believe where inflation is going to be. I also did a video yesterday going over a research paper that pretty much suggested inflation on average, once it passes a certain threshold, which is an 8% threshold, it takes on average somewhere between 7 to 22 years in order for it to recede back down to 2%, and with a median year count of about 13 years. So, we've heard from several different analysts and strategists that inflation can be very stubborn in coming down. So, of course, we're going to find out tomorrow when those inflation numbers come out, where we are for the month of March, where are we on a year-over-year basis. But the next few years are really critical for the U.S. economy with respect to interest rates, inflation, and are we going to see inflation recede back down to 2% or lower, or if we're going to be entering into an environment of relatively higher and more elevated inflation level. So meanwhile, households project that inflation a year from now, 12 months later, would stand at 4.7% versus February's 4.2%. And that was the first increase in a year ahead expectations of inflation since October. And inflation 3 years from now, so 3 years from now is seen at 2.8%, and 5 years from now expected at 2.5%. So even 3 to 5 years later, inflation is not expected to come down to the Fed's target of close to 2%, despite how many rate hikes we've already seen from the Federal Reserve. Inflation expectations are still pegged at relatively higher levels. Now, it's really important for inflation expectations to come down because that is really what drives inflation in the first place. If you think about it, expectations is what actually drives reality. Because if people are expecting prices to be higher, what are they going to do? They're going to start buying today instead of later because they expect the prices to be higher later. So they start buying today, and that drives prices higher in the first place. If people are expecting prices to be lower in the future, they're going to hold off on buying today. And as demand goes away, as more people start expecting prices to be lower in the future, well, then eventually prices are in fact lower in the future because there's not enough demand. So inflation expectations are, in other words, a proxy to the actual inflation numbers to begin with. And right now we are expecting to relatively stay higher at 4.7 to 5% even 1 year later from today. Now, how is the market playing this information? Well, the market's still pricing in 9 cuts, right? So we're still expecting a huge amount of cuts from the Fed funds futures, and about a 70 to 80% probability that we're going to see another 25 basis point hike in the beginning of May. So May 2nd and 3rd, I think, is when the meeting is from the Federal Reserve. FOMC meeting next is coming up in May. And hedge funds right now are currently loaded up with equity short positions. This actually came out very recently. So hedge funds are reloading on bearish wagers on U.S. equities, betting the latest market retreat will persist amid worsening economic data and corporate earnings. Large speculators, mostly hedge funds, saw their net short positions in S&P 500 E-mini futures increase to roughly 321,000 contracts as of Tuesday, according to the data from Commodity Futures Trading Commission, and that's the most bearish reading since November 2011, following the downgrade of the U.S. sovereign credit rating. So this is where we are with respect to the equity short position, net short position in S&P 500 futures at the highest levels since 2011. And you can see that we are pretty much going back to that level from back in 2011 when, of course, we had the U.S. sovereign debt downgrade because of a very close call with the debt ceiling. So you can obviously look at it from a both bullish and bearish perspective. Bearish because, well, they are net short, so they are expecting markets to be lower, and inflation expectations are relatively higher with respect to the Fed funds futures pricing in 9 cuts. If that doesn't happen, that is going to be bearish for the market. But then you can also spin it in a more bullish sense that, hey, if so many hedge funds are net short, that only leads to a huge short squeeze in the future, which is going to end up rallying the markets even higher because of many market participants, especially some of the bigger money managers, hedge funds, underexposed to the market, and they're going to be forced to buy at a higher price, thereby pushing the markets even higher further. So again, there's a couple different narratives here. I'll let you to decide, what you want to think of this and what you want to make of this data point. I have made myself very clear. I do think there is going to be recession at the end of this year, early next year. Inflation's a bit of a question mark. I am not 100% sure exactly where inflation is going to end up a year from now. If there is a very severe deflationary recession with the money supply shrinking, it's possible inflation comes down, but we're going to have much bigger problems to deal with respect to the economy. But if you do see a very mild recession, where unemployment does take up a little bit, inflation, it is possible that it stays a little bit on the more elevated side and doesn't exactly come down to the Fed's target, considering how stubborn it can actually be in those environments. So let me know in the comment section down below, what do you think with respect to inflation, and what are you going to do with this information? I mean, the highest net short position from hedge funds since 2011. So we'll continue to monitor this, and S&P 500 NASDAQ continue to kind of trade at that critical resistance. For the S&P, that's going to be somewhere between 4,200, and the NASDAQ, that's going to be somewhere between 12,000 and 12,300 at the moment. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. And tomorrow, don't forget, we've got inflation numbers coming out, so we will be live to cover that CPI report and kind of see how the market's reaction is. As always, happy investing, and I'll see you all in the next video.